Frage.
About 20 minutes past the hour here in Sydney. Let's check in on how oil is trading in the Asian region today, seeing a bit of a bump in NYMEX crude. This with, it's still hovering near a 30-month high. Anti-government rallies in Iran are stoking concerns about potential supply disruptions, but important to note that exports have not been impacted by protests thus far. It comes as the death toll mounts across the oil-rich nation. It's actually OPEC's third biggest crude producer. CNN reporter Arwa Damon filed this report.
Unemployment, inflation, corruption. The triggers for deadly protests across Iran. The government has acknowledged these economic challenges.
What is clear is that these threats and challenges have to be turned into opportunities.
But words haven't been enough. In fact, the protests have spread. With frustrations over the economy growing into wider discontent about the overall state of politics. Many Iranians had higher expectations for their country. This was the scene just 2 years ago. Young men and women cheering Iran's nuclear deal with world powers, hopeful that an end to years of economic sanctions would bring a more prosperous future. There have been some improvements. Growth has returned and inflation has fallen. The International Monetary Fund says the economy is set to expand by 4.2%. Iran's crude oil is being sold overseas once again. And foreign investment is starting to trickle back as well. France's oil giant Total and China's CNPC agreed to invest billions of dollars to develop a giant gas field. But many Iranians are not feeling the benefits. Daily life remains hard, and there aren't enough jobs, especially for the young. The unemployment rate for those aged 15 to 29 is around 25%. At the same time, the government's new budget is set to cut infrastructure spending and cash subsidies, while allocating millions of dollars for religious institutions. So while Iran's economic indicators are positive, the government needs to find a way to translate them into higher living standards, and fast. Amir Daftari, CNN.
Well, that's oil and what's potentially moving markets there. Let's talk about gold for a moment. It has hit 3.5-month highs. However, we potentially are seeing the precious metal heading for its first drop in 9 days. It comes after gold kicked off the new year on the front foot. So it's advanced for an 8th session after ending 2017 up 14%. What you're looking at right here is actually the potential oversold signal coming through for gold. You can see in the white line there and the red line to the top showing that it's overbought. And when we saw this happen a little bit earlier, say around beginning of September, you can see the pullback that we experienced there in the middle of the screen. So let's talk to Markus Helsing. He's joining us from JB Markets, and he's joining us from our Melbourne studio. Markus, welcome to the program. Can we start by talking about gold? So, huge gains, as we were just mentioning, in 2017. But it's all, or a great deal of it, is about the US dollar, isn't it?
Well, correct. Thanks, Nadine. Look, essentially, the US dollar has been the driving force of quite a few commodities, first and foremost on the way down. I mean, let's not forget, in 2011, major tops in industrial commodities, particularly gold and silver, but also oil and many other commodities. They've been in a bear market ever since. And when we talk about huge gains, about gold, let's just put in perspective. I mean, we were at $2,000 an ounce 6 years ago, and it went all the way down to nearly 1,000. We're currently around $13, $20 an ounce, trading at that level. I mean, it had a good bounce from the lows in September. We just think basically the correlation between the US dollar and something like precious metals is quite strong, because gold is still seen as another type currency. And with Bitcoins and cryptocurrencies being a bit in the headlines, it might have just got a bit of a lift out of that. But look, generally, we really feel what the US government has done in its wisdom and cutting taxes after after an 8-9-year money printing boom, with unemployment at 4%, is, in our view, not a wise move. And we feel that well, they willingly turn themselves in a type of an Italy scenario. Well, at some point, bridges and roads will have to be redone. And, you know, US is probably seen as being about 30 years behind Europe in infrastructure, let alone behind China. So, I mean, this thing has to be paid for. And we just find that is, on the one hand, in our view, not very wise move, and will probably lead, and that's a secondary factor, to inflation, because they'll have to issue more bonds to finance a growing budget deficit that's already running at a decent size. And so what will happen is rates will be pushed up at a time when probably a market and a consumer already pushed with high oil prices, for example, that we think are going to go a lot higher, and other things, high health costs, you name it, high housing costs, you know. So, I mean, there's a certain limit a consumer can take. So we think the pressure on interest rates will come over the next year or two, on top of already general underlying pressures. But these basic tax cuts, they are not helping and will basically be probably responsible to the point of 40% of the reasons of rising rates over the next 2 years and beyond.
Okay, so long-term bear trend for the US dollar, how much, say, could it fall in the first quarter of the year?
Well, look, I think the US dollar had a good sell-off over the last few months, as much as gold and silver benefited. Sometimes markets follow through straight away. We are actually at a very sensitive juncture in the US dollar and the likes of gold, in a mirror image, if you like. Sometimes markets just keep on going. Now, I'm probably in favor of seeing a bit of a counter correction, like a bounce in US dollar and if a pullback in the precious metals. But this might be short-lived. This might be a few weeks, a month at best. We generally think the momentum is there. If anyone looks at technical pictures, and let's not forget most funds investors, they look at the technical pictures first and foremost when you look at something like the US dollar index or gold and silver. And I mean, the silver chart to me is one of the most bullish charts I've looked at in many, many years. And US dollar, to me, I think we shouldn't look at it over the next 3 months. I think we should look at it over the next 2 years. We think the US dollar is going back where it was many years ago. I think it's going to fall between 20 to 25% over the next 2 years. 20 to
25% over the next 2 years. Wow.
On the index.
Okay. So do you think that the US dollar will be very volatile given all of those factors you were talking about, US tax cuts, repatriation of US funds, Donald Trump continuing to spend, and then rising interest rates?
Well, look, I don't want to go into the Trump thing, but I mean, he had a good run the first year, and good luck to him, and good luck to America. We just feel that the risks are building broadly. I mean, it might simply be just that the bond market at some point, the 10-year notes and the 30-year bond market in the US, at some point will cave in under pressures, and the yields will rise, and it will be simply a matter of higher long bond yields that will ultimately put an end to a very booming stock market. As you know, I believe these world asset markets, and not just the stock markets, are in a topping out mode, and I would not be surprised if 2018 is a major top out in world asset markets. That doesn't mean they have to fall away straight away, but to us the markets are so highly priced, obviously they're vulnerable to sudden setbacks.
Okay, so you're very bullish on silver. How are you sort of viewing copper, for example? Obviously had a massive run in 2017 to end the year, and off at the races, so to speak, in 2018 as well. Just quickly.
Yes, look, copper, I mean, you can't build any electric engine or a motor without copper, and I think this whole movement towards electric cars and the whole change in industries will necessitate the demand to basically underline the further demand for copper. We think the technical picture looks good. The overall picture in copper is a positive one. You can't fault it. As Jonathan Barrett pointed out yesterday, he said it beautifully, just because it was at 10,000 before doesn't mean it can't go back there again. And we feel very bullish about all key commodities. Key commodities, I mean particularly oil, natural gas, copper, and the precious metals. All
right, Markus Helsing, JB Markets, thank you so much for joining us. Lots in there to digest. Appreciate it. We'll take a short break. When we return, the energy debate reignited. Plus, we'll take a look at some of the top and bottom movers of the session so far. Best and worst performers up next.